All right, today we're going to pull back the curtain on the real secret to trading serenity, a lesson that comes straight from one of the market's true wizards. So let me ask you this. What do you think is the single most important key to trading success? Is it finding that one genius stock pick before anyone else? Or maybe, it's just nailing that absolutely perfect entry point. We're told over and over that these are the things that matter most. But what if that's not the whole story? What if that's not even the most important part? According to legendary money manager Tom Basso, the vast majority of traders are completely, totally obsessed with the wrong part of the equation. And this obsession, well, it leads them straight into something we can call the trader's trap. Let's break down exactly what that looks like. You see, most new traders spend all their time, and I mean all their time, searching for the perfect buy-sell engine. This is just a fancy term for the trigger, right? The little indicator that flashes and tells you buy now or sell now. Think of things like moving average crossovers or Keltner bands or price breakouts. They're all hunting for this holy grail that, as Basso points out, just doesn't exist.
But here's the real problem with that obsession. When you focus only on the entry signal, you completely ignore the most dangerous monster in the room, the risk of ruin. That's the real chance of losing so much money that you get knocked out of the game for good. It creates this wild emotional roller coaster that, let's be honest, most people just can't survive.
So if the buy-sell engine isn't the secret sauce, what is? Well, to find out, we need to meet the man who kind of cracked the code. This is Tom Basso. He's the real deal, managed hundreds of millions of dollars, and he was even featured in that classic book, The New Market Wizards. But here's the thing, he wasn't known for being some stressed-out, high-strung trader. His nickname was Mr. Serenity, all because he found a way to trade incredibly profitably while staying completely calm and relaxed. And his core philosophy, it's actually really simple but so powerful. It's not about hitting home runs on every single trade. The real goal is just longevity. It's about staying in the game long enough for your strategy to actually work, and the only way to do that is through consistency. So how did he achieve that consistency? How did he become Mr. Serenity? He did it by focusing only on the things he could actually control, using what he calls the 3 levers of position sizing. Let's dig into how they work. Okay, the first lever is risk. Now, I know the formula might look a little technical, but the idea behind it is super simple. It just makes sure your trade size is always based on a maximum loss that you've decided on before you even place the trade. This means if a trade goes south, you only lose a small, manageable piece of your total capital, maybe 1%. This one rule prevents any single trade from ever blowing up your account. It's a game changer. The second lever is volatility, and this one is all about managing your own psychology. It sizes your position based on how much a stock or whatever you're trading typically moves in a day. By doing this, you're actually controlling the size of the daily profit and loss swings, which makes the whole ride so much smoother and keeps you from making crazy emotional decisions on a wild market day. And the third lever is capital. This is a simple but absolutely vital safeguard. All it does is make sure that no single position eats up too much of your total trading capital. This keeps you diversified, and importantly, it ensures you always have some dry powder ready for the next opportunity instead of being all in on just one idea. So, you've got these 3 different calculations. What do you do with them? Basso's golden rule is beautifully simple. You calculate your position size using all 3 levers, and then, and this is key, you always take the smallest result. This acts as your ultimate safety net. It basically forces you to take the most conservative and survivable position. And the difference this makes is, well, it's dramatic. Just look at this. The top chart shows a pretty simple strategy, just trading one contract at a time. See how erratic and choppy it is? Look at that huge, long drawdown. Now, the bottom chart shows the exact same strategy, but with Basso's sizing rules applied. The journey is so much smoother and the end result is way better. Let's put a hard number on that, because this is where it gets really interesting. The maximum drawdown, that's the biggest loss your portfolio took from a peak, was almost 15% in the base case. Just by applying these sizing rules, that loss was cut down to under 13%. Now, that might not sound like a huge number, but psychologically, that kind of risk reduction is everything. It's the difference between sticking with your plan and quitting at the absolute worst possible time. But the story doesn't end there. Not with just setting your size at the beginning of a trade. Basso has this powerful story about why sizing is an ongoing job, and it's a wild lesson in surviving a winning trade. So Basso describes this period where he was just a complete mess. He was stressed out, couldn't sleep. He was calling his broker every single hour. Now, what do you think was happening to his account when he was feeling this way? Here's the twist. This wasn't happening during some terrible losing streak. This was all going down while he was in the middle of the single most profitable trade of his entire life. He was making more money than he'd ever made, and he was absolutely miserable. So why? What was going on? It's because as the trade became this massive winner, the position size grew enormous. The daily swings got so big that the position's volatility started managing him. He wasn't in control anymore, the trade was. And that is the critical lesson. You have to continuously reevaluate and right-size your positions, especially as they grow. Which brings us to the ultimate goal of this entire process. It's not just about some formula. It's about finding your personal sweet spot. For Mr. Serenity, the right position size was whatever let him stay calm and relaxed. But, as he says himself, that level is different for everyone. The whole goal of using these levers is to dial in your exposure to a level that allows you to trade with discipline and without all that gut-wrenching emotion. When you really boil it all down, position sizing isn't just a mathematical exercise. It's the bridge. It connects your strategy to your psychology. It's the tool you use to balance the needs of your portfolio with the very real limits of your own mindset. So the question to leave you with is this. When you look at your own approach to trading, are you building a strategy that's actually designed to create long-term wealth? Or is it a strategy that's just creating short-term worry? The answer, more often than not, lies in how you size your ride.